We've got a lot of catalysts to talk about in this video. We're going to look at expectations for Tesla earnings as well as some other catalysts. But look, folks, we just got this from the IRS and the Treasury Department. These are the models that qualify for the following tax credits. It looks like the Model 3 standard range will be or see its credits reduced from $7,500 to $3,750. That's the only tax credit that really gets reduced for Tesla. That is the approximately $42,000 Model 3 Tesla. That basically just got a price hike of $3,750. All the other models maintained their $7,500 credit. Rivian did not get the credit. Lincoln's, you've got, well, you can see on screen here, the Grand Touring gets $7,500. Corsair Grand Touring gets $3,750. Get a couple Jeep at $3,750. You've got the Mustang Mach-E Extended and Standard at $3,750. The Lightning gets the full $7,500. Escape plug-in $3,750, and you can kind of pause the screen here and see some of the others. Lyric from Cadillac, it's the full $7,500. With that said, let's get into catalysts. Well, we've got a lot of catalysts to talk about this week for the stock market, including 420's Tesla earnings. We're going to talk about what some of the expectations are for Tesla earnings, but let's also go through some of the economic data we're expecting this week and which matter the most. This morning, for example, we got Empire Manufacturing that came in a lot stronger than expected at 10 points versus negative 18 for the survey or negative 24.6 prior, suggesting maybe the recession isn't as close as people might think it is. Tomorrow on the 18th, we'll be getting building permits, be a little bit of an indicator for what we're seeing in housing as well as housing starts. We're looking for a 1.5 or 1.45 million permits. That's a month-over-month decline of 6.5%. Is it going to come in hotter than expected, along with housing starts expected to be negative 3.5%? Will those rise as the real estate market so far this year has actually been booming? Very little inventory leading real estate prices actually to rise. Some of those year-over-year fears that we were looking for in May may not end up coming to fruition. Initial jobless claims are expected for a Thursday, 420 at 420. And then on Friday, we'll get some manufacturing PMIs, services PMIs, and then a combined PMI. All of those expected to be around 49 to 51. More importantly, this week are going to be earnings, though. So today we'll be getting Charles Schwab, although actually some of their earnings actually just already out, 93 cents on EPS. Revenue slightly misses. After the bell on Monday, we'll be getting a J.B. Hunt. Now, that's a transportation service, and a lot of people like looking at J.B. Hunt as a potential inflation indicator for freight, since freight really affects almost every company. Whether you're shipping servers in, you're shipping clothing out, who knows? A lot of people like looking at freight companies, so J.B. Hunt might be an interesting one. A lot of talk of layoffs happening at freight companies because of weaker demand. Bank of America reports before the market opens tomorrow. Johnson & Johnson, Goldman Sachs, Lockheed Martin, Bank of New York Mellon. So some more bank and defense earnings tomorrow morning. And then things get entertaining. Then we get into what Ryan Reynolds calls one of his favorite stocks. In fact, just this morning he was on CNBC pitching, I think it was Nuvi or Nuvo or something like this, some Canadian fintech company. And the folks on CNBC are asking him, so what do you know about financials? And he's like, absolutely nothing, in classic Ryan Reynolds style. And he's like, I just like the emotion of companies. I'm a marketer. Yeah, and in fairness, he's a great marketer. He's incredible. He's an inspiration for many. But some other companies that he thought were an inspiration to him, in addition to Netflix, was actually Ford. I was kind of surprised. He's like, oh, it's a legacy company, part of the American fabric. And I'm like, it's going to be part of the American BK if they don't innovate soon with getting their costs down on those EVs. But anyway, so Ryan Reynolds, big fan of Netflix. He's kind of made the argument that he can't really bet against it based on the industry that he's in. Netflix reports earnings at 4 p.m. on Tuesday, and it is usually seen as the signal for kicking off tech earnings. And it seems like every earnings season we get to, Netflix is the one that everybody's kind of like, man, if Netflix comes in good, it's good. If Netflix comes in bad, it's bad. They did go back to growth in the last quarter, which was great. We are expecting a movement of 8% on Netflix stock tomorrow afternoon. That's down from the average movement of 12.3%. Earnings per share expected to come in at 2.87 with revenue of 8.18 billion and net income of 1.34. So we'll see what happens with Netflix. After Netflix, we'll get United Airlines, Interactive Brokers, those Tuesday afternoon. Then on Wednesday, we're going to be looking at Morgan Stanley in the morning. And in the afternoon on the 19th, this is the 19th. Okay. Wednesday afternoon on the 19th, we'll be getting Tesla earnings at 4:05. Ross Gerber is apparently having a Tesla party on 4:20 the next day. SpaceX is actually expected to launch potentially one of their vehicles today or tomorrow. We'll see what ends up happening. This is the big one people have been waiting for. But anyway, Tesla on the 19th, expectations. We'll talk about Tesla in just a moment. We'll circle back to Tesla. IBM reports on Wednesday afternoon, as well as Las Vegas Sands. And then on Thursday morning, we'll be getting AT&T and Taiwan Semiconductors, along with American Express and D.R. Horton. So we'll be getting a look into housing, not only D.R. Horton, but Blackstone. A lot of those REITs, a lot of Blackstone's REITs are seeing liquidations. A lot of talk about pain in commercial real estate. How is that going to affect the broader economy? American Express, what can they tell us about that wealthier consumer? Is American Express still going to tell us that people are spending through the recession, or are we going to see an inflection where people are no longer spending through the recession? Taiwan Semiconductors, hey, what's going on with China? Are any potential issues with China still present? How much is China adding to a book of business or taking away from the book of business as Taiwan Semiconductors? What about international sales to the United States? Is the chip market really growing because of the AI revolution? I expect to hear a lot from Taiwan Semiconductors about none other than chips. Of course. Excuse me. And specifically because of this AI revolution that really began, it's been going on for years, but really exploded over the last couple of months here. We'll be talking a lot about Google in a different segment, especially with the potential for Google scrambling and shaking in their boots as they may be losing some billion-dollar contracts. We'll be talking about that. All of this, of course, driven by AI. On the afternoon of Thursday, we'll be looking at Seagate. We'll get a little bit of a look into maybe memory and more specifically storage for Seagate. Both of those are my least favorite segments, as I find them to be more commodity-ish. That might be offensive to some people in that field, but I hate to say it, but I feel like SD cards and SSDs and memory are a little more commodity-ish. Procter & Gamble on Friday morning, we'll be looking at some of those consumer staples. As well as Friday afternoon, we have nothing, because you generally don't have anything on Friday afternoon. So I said we'd talk about Tesla. Let's try to look at some expectations for Tesla. The most important thing, in my opinion, for Tesla is going to come down to margin. It's going to be very simple. Is how bad did the margin get in Q1? And the question isn't necessarily how bad is it going to get in Q1, since we already have estimates of that. And we know that Zach, the CFO, told us we don't expect to go under 20% gross vehicle margin. How bad, though, is that margin going to potentially get in Q2? Remember, in Q1, we have pretty much an entire quarter of Inflation Reduction Act credits of about $7,500. Unfortunately for Tesla and a lot of EV manufacturers, the $7,500 credit is actually going to fall to $3,750, which could potentially lead to more price cuts for Teslas. In fact, here at the top, you can see the $7,500 tax credit for the Model Y and Model 3. Model 3 rear-wheel drive will be, however, reducing to $3,750 on April 18th. So, you're seeing some models that are going to get impacted with a lower Inflation Reduction Act tax credit. What does that potentially mean for Tesla margins? If Tesla had a $7,500 credit all throughout Q1 and only has a $7,500 credit on all their vehicles for the first 3 weeks of the quarter, which means you actually have a whole other 11 weeks essentially to go. Actually, a little less than 11 weeks. That'll be more like 9 weeks to go. There we go. Let's get our math right. well, then the bulk of Q2 is actually not going to have the full $7,500 credit, and that could really hit margins more. So what are expectations right now in terms of margins? Well, expectations are the following. Let's go ahead and pull these up on screen here. These are the margin expectations that we have. The expectations are simple. We're looking at automotive gross margins set to decline once again. We had our peak in Q1 2022 where we actually broke over 30% margins, but the expectation is that these could go down to as low as about 23.1%. 23.1%. There are 17 analysts interviewed by Reuters, and the average estimate is 23.1%. Some estimates are lower, some are higher, but this is going to be a big deal. And I think the biggest part is going to be, hey, what are those expectations for Q2? Because again, this right here on screen is the Q1 expectation. Now, we'll look at the expectations for actual earnings, but I think there are going to be two main things we're going to be looking at. I'll explain the second in just a moment, but number one is going to be gross margin, including the path forward on gross margin. Right now, we're expecting an implied one-day move on Tesla stock after earnings of 6.51%. That is in line with the average movement of 6.4%. Regarding earnings, we're looking at an adjusted EPS of 86.3 cents, GAAP EPS of 77.1 cents, revenue of 23.46 billions. That's the top line. Looking for a net income of 3.05 billion, operating profit of 3.06 billion, and that's the adjusted net income, by the way, and EBITDA at 4.43. Now, keep in mind that Tesla has had sort of a mixed record on earnings here when it comes to adjusted EPS. 5 out of 8 times you beat. However, they're almost always right on net income. If they miss here, it could be painful because they'd be breaking a trend. They have beat 8 out of the last 8 times on net income, adjusted net income. So we'll see if they continue to beat this time around. These are the current estimates. Again, margin being the number one, but I think there's also a number two. I think the number two thing that we really want to pay attention to for Tesla is going to be the free cash flow. Now, the reason I mention free cash flow is because I personally believe that Tesla doesn't have as much cash as people like to say they do. Now, some Tesla bulls think I'm just trying to be a bear, or for some reason I'm trying to like clickbait people into thinking there's a problem. But the reality is, Tesla's cash isn't as great as it seems. In fact, if we jump over to their cash flow statement, first of all, we see that regularly Tesla's spending about $1.8 billion in CapEx expenditures. And from the third quarter to the fourth quarter, which the fourth quarter is usually that really big sell-through push for vehicles, we actually saw free cash flow decline from just over $3.3 billion of free cash flow down to about $1.3 billion of free cash flow. And the concern is, what if that contracts even more in Q1? We'll see if there were any potential credits that could potentially hold this up as well for maybe electric charging inputs or electric charger manufacturing from the Biden administration. But consider when we jump over to the balance sheet over here, yes, everybody likes to look at the top line right here of suggesting, yeah, Tesla's got 22 billion cash. That's fantastic. They've got a lot of money in cash, and we know they've got about 12.8 billion in inventory. But they've got bills sitting on their desk of over $23 billion. I mean, just the first couple lines over here on the right shows you $22.3 billion of payables and accrued liabilities that need to be paid now. That's not even including customer deposits, deferred revenue, which I generally don't consider those as debts anyway. And then, of course, you've got other long-term debts here at $5.3 billion. So when you add up all the debts, you're sitting between $23 to $28, $29 billion, substantially more than the amount of cash that Tesla has, which means we want to see continued cash flow. I'm not offended by the balance sheet at all. I'm just worried that if we start seeing free cash flow go under $1 billion, maybe we start going towards somewhere around 500 million. Personally, I get a little bit, I'm going to start scratching my head a little bit about, hey, is Tesla going to have to enter any kind of financing agreements to get through 2023? And these are probably the worst times to enter into finance agreements. In fact, Morgan Stanley's Mr. Mike Wilson has the argument that usually what happens is in a recessionary environment is that you end up seeing earnings slow, gradually, and then suddenly. He had a piece, and now we know he's a bear, okay? We know he's bearish. He talks about $1 trillion having left the banking system over the last year. He talks about small business credibility shrinking to its lowest level in 20 years, while interest rates are at a 15-year high. Keep in mind, a lot of entrepreneurs and business owners end up with Teslas because they use Teslas as a tool for advertising their business, or they just want a Tesla, whatever it is. But Mike Wilson talks about this idea that we could have a gradual and then sudden decline in earnings. And the reason for that is right now you see this gradual decline in earnings, but you could all of a sudden drop off a cliff like we have in the past. In fact, these are sort of generally what we tend to see. Here in 2007 to 2008, you saw this gradual decline in earnings, and then all of a sudden you saw a crash in earnings. You jump in over here in the COVID era, what do you see? You kind of see this gradual softening in 2019, late 2018, and then of course the COVID crash. I personally would remove the COVID crash from this analysis because I think it's a little ridiculous to have the COVID crash in here. But I think it's a good analogy to look back at 2007 and 8 and say, hey, look, this gradual decline in earnings became a massive decline in earnings. And part of the reason that happens is because businesses are able to, as earnings gradually decline, businesses are basically able to refinance through the pain with cash that they have. They're not actually exposed to debts yet. But what happens when that cash runs dry, when earnings decline to the point where you don't actually have as much cash anymore? Now you have to go to the bank at really expensive rates. What happens? You're basically screwed, and then earnings suddenly decline. Now again, I think Morgan Stanley here and Mr. Mike Wilson really only give us one good example of this. They didn't decide to go back further into history, potentially, because maybe it doesn't rhyme the way Morgan Stanley's Mike Wilson prefers. And I don't think you can really include COVID here. So he's got a good example for 2007 and 8. I'll give him that. And he's not wrong that, yes, margin degradation can be a lot more sudden. As at first revenues slowly disappoint, and then all of a sudden you get a more meaningful acceleration in declines. I personally think that margin squeeze could really occur if the event occurs where Tesla needs to borrow to continue to fund their expansion. Now, according to Bloomberg, Tesla, we already know this, Tesla delivered a record 423,000 vehicles globally in Q1. That's 36% average growth year over year, maintaining 50% average volume gains, but putting gross profit at risk. That's regarding production. A surge, the surge failed to halt a rise in inventory. Yeah. Let's see here. Consensus calls for 1.8 million vehicles to be sold in 2023, not exceeding 3 million until 2026, with an average growth rate of just 20% expected for Tesla, according to Wall Street, while the company targets 50%. Myself, I'm sitting somewhere between 30 to 35% on my projections, so I'm somewhat in the midpoint there. Tesla's EV market share has hit 86% in Q3 of 2018, and it slipped to an EV market share of just 57% in Q4, though many argue that as the pie grows, you actually need less of the pie to continue to push the strength of Tesla. Tesla has also cut prices quite a few times, and the question is, how are those price cuts really going to hit? We've seen most of the price cuts, I believe about 5 price cuts now since January, and we haven't had an earnings report that kind of gives us some light into those price cuts until, well, 2 days from now. So that's going to be a concern. Now, there will be some potential relief, and some of that potential relief may come in projections that Tesla or Elon Musk gives us in terms of the battery packs. We know that Shanghai is expected to manufacture, expand the Shanghai Gigafactory and manufacture a substantial set of mega packs, potentially as many as 10,000, but that's going to be expensive to ramp before we start seeing those numbers come through. Same thing for Giga Northeast Mexico, and if there's another Gigafactory that ends up being announced in, say, Vietnam or Indonesia or wherever, these are all expensive projects that aren't leading to cash flows just yet. So those are all things that we're going to be looking for in this next earnings report. Biggest thing for me, though, margin cash flow, and then of course hopefully we get something to soften the blow in the way of not just batteries, but also FSD. FSD will be a potential tool for maybe propping up some of these revenues. If we see a larger take rate on FSDs, and maybe we could start including a little bit more revenue for FSD. We do know that Zach, the CFO of Tesla, has told us we will be seeing more FSD revenues recognized as they continue to roll out full self-driving. They did just roll out for FSD 11. I think they're already on the third or fourth update for number 11. I've certainly done at least 2 updates on number 11, and I'm usually a little bit behind in the updates. I just don't drive that much. But I will say, just as sort of an anecdote between myself and you, Tesla full self-driving on version 10.0, 95% of the time I could trust the car, but there were certain parts around my town where I'm like, it can't handle this. It can't move from, a right turn exit off of a freeway and then needing to get across 4 lanes to make an immediate following left turn. It was incapable of doing that. It has gotten substantially better at being able to do that. It still doesn't get all the way, but it's probably gotten 8 times closer to making that left turn lane. And there's also a part in my town where it usually, when I used to get on a highway, there were some construction barriers that came up pretty suddenly. I would hold it until the last second to see if FSD would ever turn. And on version 10, it wouldn't. And I'm like, all right, I guess I gotta take over. Version 11 has solved that. Version 11 has also solved some funky merges where it used to cut off bike lanes and basically use right turn lanes into neighborhoods before getting to a main intersection. So you're kind of coming up on a main intersection and it just turns right so early that it cuts off the bike lanes and the neighborhood right turns, when it should actually stay in more of one of the primary lanes and then turn right into its right turn lane. FSD 11 has done that. So the FSD is getting really incredible. You really can't make a long-term bet against Tesla, in my opinion. But if you're making short-term plays, there are plenty of reasons to potentially be disappointed on the 19th. But don't worry, 420 is just a day later and you could party your sadness away. So my take here on Catalyst, I'm honestly not terribly concerned about Tesla. It's going to do what it's going to do. It usually goes down after earnings, so if you're nervous about it, sell some calls. I'm not optimistic about seeing a big upside surprise, but hey, if you're thinking there's a potential for an upside surprise, add some shares or maybe sell some puts. Who knows? Maybe it'll stay stable. More importantly to me, for Catalyst, I want to know what's going on at American Express. I think American Express is going to be a much bigger catalyst, even though it's not going to get the news as much as Tesla. For me, it's going to be a bigger catalyst as to whether or not this recession is actually coming. I think American Express is going to be a tool for that. And now I understand that American Express really focuses on the higher net worth consumer and the higher income consumer. But generally, the companies that I'm investing in are exposed to that consumer base. So from a personal point of view, that is the company that I really want to pay attention to for sort of that broad-based spending, as well as, of course, the artificial intelligence drive, which I think we'll get a lot of insight in from Taiwan Semiconductor. So we'll see. But those are my expectations on Catalyst for the week, including Tesla. So look at that. I went a whole segment without pitching you once on either the programs on Building Your Wealth link down below, the paid promotion on life insurance you can get in as little as 5 minutes, or streaming with me at StreamYard by going to metkevin.com/StreamYard.